Hello analysts, and welcome to the 360 Huntington Fund's video series on equity valuations. In this video, I'll be showing you how to retrieve and input the required values for the historical relative valuation models, as well as cover some basic concepts that you should be familiar with. Please keep in mind that additional information on historical relative models can be found within the course packet that is available to all analysts through Blackboard. Let's get started. So what we're going to be discussing are the historical relative models that are down here. Historical price to earnings, price to sales, price to book, price to tangible book, price to cash flow from operations, and price to free cash flow. Basically what each one of these models is doing is comparing your company to a peer group and looking at how much the average investor is willing to pay per dollar of earnings, sales, book value, so on, and look at your company and what investors are willing to pay for that. So the assumption here is that if your company is similar, and that's why we pick similar comparable companies within the same sub-industry or industry, if your company does essentially the same thing and is producing X amount of earnings, then it should be valued at the same or close to the same amount as its comparable companies should be. It could be that investors haven't realized this, or there could be other extenuating circumstances, but that's the general point of what we're trying to do here. So what you're going to need are some PDF reports from Value Line. You're also going to want to get some information off of Bloomberg, and you can calculate some of it yourself as well. But just to walk you through the price to earnings, so what we're going to be doing as the example today, you're going to need that information. So if you go to library.neu.edu, go to Browse by Subject Guide, click Business and Management. Go to Business Research. And down here under Databases, you'll see Value Line. And you're going to click to connect to Value Line. And if you are off campus, you may need to log in using your username and password. If you're on campus, you won't need to do that if you're connected to the network. So you're going to want to enter in your company name here, and you're going to want to download a report for each one of the companies that you're evaluating. So the comparable companies all have reports as well, so you're going to need that information. So it's MIDD, Middleby Corporation, and it will bring you to a page that looks like this. You're going to need the PDF reports, which is off to the side here. You're going to want to click on the most recent version, and it will bring up a sheet that looks like this. What you're going to want here are the historical prices, the highs and lows for the particular stock, and this is adjusted for splits, so you don't have to worry about that. You're also going to want the sales per share and the earnings per share. The book value per share, you can get it from here. It would be preferable if you calculated it yourself from the balance sheet. The tangible book value you'll have to calculate yourself, as well as the cash flow from operations and free cash flow. You'll need to calculate each one of those for each of the companies that you're using for comparison. So once you have this information, you're going to go into your valuation, and you're going to start inputting the low and high stock prices for each one of the companies, as well as the annual earnings per share. What this will end up doing is being calculated into the high and low price to earnings ratios for each one of the companies. And here's where you're going to want to look out a little bit. So you can see that generally you're seeing values within a particular range. So for this, you're looking at between 10 to 30 for Middleby. But what you're going to want to look out for are outlier figures that are going to mess with your valuation. So you can look at the averages to figure out, okay, does everything look all right? And then you're going to want to look at the individual companies, like, okay, Illinois Toolworks looks okay. But then, you look at Manitowoc, and you see a 305 and 149, price to earnings valuation, and that doesn't seem right. And what that will do is it will ultimately mess with your target price down here. So you're going to want to eliminate things like that. And if you come across a company that has too many outliers, or your company has negative earnings, or if there's negative PE ratios, you're going to want to eliminate all that information. So let's say, for example, if the PE ratio, let's say Middleby had a bad year in 2011. Let's say it was negative 30 cents a share. So you see, oh, this is negative. So you can't use any of the information from this particular year. So you would have to delete all of that information. Now you would also be messing with the formulas down here, so you'd have to delete those as well. So that's what we're basically looking for here. Let's undo all of that. So you can see here, when you go along and look at Manitowoc, you would want to delete these values here. These are going to mess with your valuation model and cause artificial increases or decreases in the target price. So you'd remove those. Now you can see that before this was around $85 a share. So if we put these back in, $85.54. When you delete these values, they have a huge impact, because what it's doing is it's assuming that if one of the peer group companies was valued at 300 times earnings, then your company should be evaluated on the same basis and should therefore be priced at more appropriate levels of closer to 300 times earnings, if that's what the peer group is trading at. But obviously that's not the case, because you're looking at outlier years there, which may have been bad for this particular business, and so on. So with those numbers removed, you get a more appropriate target price, because you see that everything is kind of within an appropriate range here. So ultimately this leads down here to using the historical averages. And what essentially you're doing here is taking the peer group high-low average. You're looking at the low relative multiple average, so you're taking Middleby's relative PE multiplied by the peer group average. You're getting the low and the high, and then you get the average between those two. Now, here's one of the most important parts of this equation, is the price to earnings for the trailing 12 months. Now, you put this information, so you can see it's referencing the summary page. So what it's referencing is the earnings per share in K5 here, as well as the current price. So it's the price divided by the trailing 12-month EPS. And that is giving you the price to earnings for the trailing 12 months. Now, this forward EPS comes from your income statement. It's right down here. It's based on your forecast for the upcoming year. Now, each one of these historical models has that figure in it, forward SPS, which also comes from the the income statement. So here's your forward SPS. And this is ultimately why you forecasted things in your balance sheet for the book value per share, as well as the tangible book value per share for the coming year. Same thing with the cash flow statement. It's the whole reason that you forecasted the operating cash flow for the coming year, as well as the free cash flow. So what you're essentially doing is you are taking the trailing 12 months price to earnings ratio, multiplying it by the forward-looking earnings per share. And what that does is it comes up with a value that it comes up with the price expected based on your forward-looking earnings per share. And then it also looks at the peer group average expected. Now, this is just for display purposes. This doesn't actually affect your relative model, but it's just for you to understand what the peer group expected price would be if earnings per share was $3.23, for example. But because that's not the appropriate forecast for the comparable companies, it's not used in the actual valuation process. Like I said, it's just for the information. So you look at the relative low target multiplied by the forward earnings per share, and the relative high target, and then the average of those two numbers is your relative price to earnings target price. Now again, this is for each one of these valuation models: forward price to book, tangible book, cash flow from operations, free cash flow, and so on. So the same thing holds true for each one of these. So the price to earnings and price to sales, price to free cash flow, and price to cash flow from operations all essentially have the same purpose here. You're looking at what investors are willing to pay for a dollar of earnings, sales, cash flow from operations, free cash flow, and so on. So historical price to sales is the least comprehensive and should only be used if your PE model has a lot of negative numbers, a lot of outlier information, a lot of missing information that can skew the target price valuation. So if your PE model is riddled with outliers and negative numbers, you can't use it. And you can then therefore not use price to cash flow from operations or price to free cash flow either. Now, the reason that it is because if your company or peer companies had, negative earnings in several of the years, let's say, net income is the base point for cash flow from operations and free cash flow. So any negative earnings is going to show negative cash flow from operations, negative free cash flow as well. So in those circumstances, you would use the historical price to sales. Now, where the price to book and price to tangible book come into play are looking at acquisition targets. So price to book would be used in a circumstance where a particular company is being acquired and it would be continuing its operations essentially under its same name. Because what that does is it keeps the intangible assets like goodwill, brand name, so on and so forth, the intangible assets into consideration, putting a value on those. Whereas the historical tangible book value, when you would use this model, would be when you're looking at a company's worst case scenario base price. Because when you subtract all the intangible assets, you're looking at the assets of the company that could actually be sold for cash in order to pay off debts and shareholders. So when you're looking at the ultimate outcome for the price to tangible book value, you're looking at what would be considered the absolute bare minimum that this stock should be worth. So obviously, if it's trading below its tangible book value, you would assume that you could automatically, assuming everything was correct, that even if the company went under, if it had all the assets to pay off its debt and still had assets to pay off the shareholders, that you would gain to invest, from investing in this company if it's below its tangible book value, because it has the assets to pay off the shareholders if it becomes insolvent. But this doesn't work if your company that you're evaluating has negative tangible book value, which means its intangible assets and its goodwill are a large part of its total assets. Because what ends up happening is the negatives, a negative times a negative equals a positive. So what ends up happening is when you multiply the two negatives together, you end up with a positive value, and it screws up the valuation. So in this case, you can see that Middleby has negative tangible book value, meaning that it's really only worth something if it continues operating under its same name. So again, you wouldn't want to use this if there is negative tangible book value for your particular company, because it will mess up the valuation. So in conclusion, these models are used to compare your company versus other companies in a couple of different multiples, and ultimately come up with a target price, in relation to what its competitive companies are trading at. This is a substantial portion of the valuation process and usually holds a considerable weight when determining an appropriate target price. If you need more information on the particular ratios that are used in this, it can be found within the course packet. And if you still don't understand, please feel free to reach out to your sector manager Chief of Research for the Managing Director to get some more information to find out what you should be doing or how this all works. The next video that you should be watching would be the net present value models video, which handles the free cash flow to firm model as well as the dividend discount model, and kind of guides you through these and what you should know and understand to put all of these together. So with that, thank you for watching. If you have any questions, please contact your manager to find out more.